In other business news, economic forecasts are growing over the expected outcomes of the current South African Reserve Bank Monetary Policy Committee meeting. The outcomes to be announced by the central bank tomorrow will include the latest interest rate decision. Market consensus is of yet another hold on the repo rate at 8.25%, following 4 consecutive decisions prior, as inflation remains elevated at 5.2%. Portfolio manager at PPS Investment Reza Hendrickse joins us for this conversation. Thank you so much for your time, Reza. Of course, many of us in South Africa would like to know what is the expectation this time around.
Thanks for having me, Tumi-sang. It's a pleasure to be here. I would agree with consensus. It appears, or at least we think, that the SARB will once again keep rates on hold. We've seen in the messaging at prior MPC meetings, we've had 3 so far this year, and each time it's been a unanimous decision by the MPC members to keep rates on hold. We think we're going to have to wait a little bit longer before we see rates come down, unfortunately.
How much longer would that be? Because the anticipation is hitting us hard in our pockets.
Absolutely. I think anybody with some debt or a mortgage, and that happens to be most people, would certainly be looking forward to some accommodation on the monetary front, or some rate cuts, in other words. But at the same time, I think savers are actually enjoying these higher yields. I have to say, even people approaching retirement, or even in retirement, are benefiting from these high yields. But I would say we've got 2 more meetings subsequent to this one that we're seeing tomorrow. And so potentially September and November is when we might see the first cut.
What then would justify an ease in the monetary policy as it stands, given that inflation in the current form at 5.2% is still quite higher up in the benchmark of the Reserve Bank's target range of between 3% and 6%?
That's absolutely right. I mean, inflation sort of close to 5%, which is where it's at. And we know that the SARB would like it to be nearer to that 4.5% mark. And if we read the commentary from the last meeting, they're of the view that it will reach that point sort of middle of next year. And so quite rightfully so. Inflation is still sort of stubbornly high locally. But that's only one part of the equation. I mean, there's commentary out in the market that seems to suggest that perhaps the SARB is waiting for the Fed to move before just to open up that window to allow the SARB to move as well. And that's possibly the case. I think if one looks at where real rates are locally, and that's the difference between our policy rate of roughly 8% and inflation of about 5%, that gives you around 3%. And similarly in the US, we've got rates at 7% on the Fed funds rate, inflation of about 2% and a bit, and that gives you a real rate of 3% there as well. And that's not great from the SARB's perspective. They ultimately want to see a positive real rate, which historically has been around 2.5%. And so, and that's also helpful from ultimately we want positive real rates, a positive real rate differential with the US especially, because that is what's ideally wanted for a currency like ours that is predisposed toward weakness.
You mentioned earlier the advantages of the current interest rate level for savers, but when we look at what an interest rate cut would mean for most South Africans, what picture does that paint?
So do you mean with reference to how much one is saving on a mortgage, or?
I think definitely overall on a mortgage or any other debt that is related to a lending rate based on the repo rate. Basically, the question I'm asking is whether there would be fundamental relief with a cut as low as maybe a 25% basis point.
Yeah, absolutely. So 25 basis points might not sound like much, but on a substantial mortgage, it does translate to quite a few hundred rands and potentially even up to 1,000 rand. But you're absolutely right. I mean, a quarter basis point doesn't seem like a lot. It probably would mark the start of a cutting cycle, though. And so if we take the view that the SARB wants to see rates at a more neutral level of around 7, and they're currently at about 8.25, that could mean up to 5 cuts over this cycle. I'm not saying it's going to come successively, but over the next year or two, we could certainly see rates come down as much as 1.25% if it was to reach the SARB's neutral rate.
Lastly, what more is it that the MPC would be deliberating on? They do not only gather to decide on the interest rate, especially now that we are in a period post the elections.
Yes, so I think one of the things that the SARB does, and the governor certainly, is that they talk about things like economic growth. We know that they're expecting growth of around 1.2% this year, which is twice last year's growth, in fact. But we're starting to see some softness in the economic data more recently. We know first quarter growth wasn't where it was expected to have been, and we're seeing now, sort of through May data, we're seeing industrial production, mining production, even the PMI seems to suggest that the economy is not yet firing on all cylinders. And so growth is certainly one of the things that will be spoken about. If we are to reach that 1.2% target, we're going to need to see some strong growth come through in the third and fourth quarter as well.
Thank you so much for your contribution. Reza Hendrickse is a portfolio manager at PPS Investments, talking to us on the eve of the outcomes of the Monetary Policy Committee meeting that will include a decision on the interest rate. It is expected to be announced tomorrow afternoon.